Okay, good morning and welcome back everyone to our Options Education Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. We have quite a bit to cover with you as equity markets over the past couple of trading sessions have recovered quite a bit of the weakness that we have seen, but we're not out of the woods yet. So let's go ahead and get started. Now, before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off with the US market update as we normally do. And then I want to take a look at some of the global markets because we are seeing quite a bit of weakness if you look around the world, especially compared to US equity markets. So we want to see where that weakness is and just how weak the other equity markets are around the world. I do want to take a look at fixed income and commodities because we continue to see some movements there in the fixed income markets. Also gold and silver making some significant moves this week, looking at whether there are some opportunities there. I want to share with you some of our economic indicators, what we're currently seeing, how that affects the different trade ideas that we have, and then our trade ideas. And at the end, if we have a few minutes, we'll answer your questions for the session. Now, the primary question that I think we've been getting over the past couple of trading days is really, are we back in this bullish trend? We had a very strong Friday followed by a very strong Monday. And today we're opening up flat on the day, going into the first presidential debate. There's a little bit of a pause here on that rally. So the question is, have we resumed this bullish trend, or are we still in more of a neutral, potentially downward trend? That's the primary question I hope to try to answer. Now, my name is Tony Zhang. I'm the chief strategist here at Options Play, and what I want to do this morning is share with you my technical charts to give you a sense for how I'm looking at the markets from a directional perspective, different asset classes around the world, as well as the different ideas that we have. So I want to share that with you. So first of all, let's take a look at the NASDAQ 100 index. So we've said that for quite a bit of time that 270 was the line in the sand, which we initially plunged to that 270 level. And after having a couple of weeks of fairly choppy price action, trading below it, we've managed now to get back above it. So the question is now, the fact that we're back above the 270 level, is this downside trend, is this downward trend over, and are we going to now resume that upward trend? So certainly the reversal back over the past couple of trading sessions puts it fairly strongly, especially on a break above 270, but we're not out of the woods yet. There still remains two fairly large resistance levels, 280 and 282 here to the higher end. If we fail to break above that level, which I believe we should be testing that level in the next few days, if we fail and then potentially break back below the 260 lows that we have, that would put us in a much more bearish state. But we are just fairly close to breaking above that 280 level. We can break above 280 level, then I would say that we can continue this longer term bullish trend, retest that all-time high, and potentially continue moving higher. But we could see a failure here at the 280 level. So this is the level that I would pay attention to. Below 280, I'm still more in the neutral camp. Above 280 is when I would get back into that bullish, the resumption of that bullish trend. Now, when we take a look at the S&P 500, very similar setup here. What it starts to look like is what could be the start of a head and shoulders formation. And what that means is that you could have a potential revisit back down to the 300 level. But if we break back above this 343, 342 level here, that would invalidate that head and shoulders pattern and start another long-term bullish pattern, testing that 359, 358 all-time high here on the S&P 500. So if you look at the S&P 500, a little bit weaker. The momentum is clearly on the negative side now. You have daily money flow now in the negative. Weekly money flow still remaining fairly strong, but also momentum starting to roll over again, especially with the weekly chart below that 340 level, which is the February highs. The fact that we have not gotten back above those February highs is concerning. We would really need to get back above that 340 high to invalidate not only the small head and shoulders that we see forming here, but perhaps the longer term head and shoulders here that could turn into significantly weaker if we were looking at a broader based picture. So short term, long term, we're starting to see some topping formations. Markets can invalidate these topping formations and start to break higher, but At the moment, these formations are still intact at the moment. Now, if we look at small caps momentum continues to decline. On the weekly chart, the momentum is starting to roll over and starting to turn negative. On the daily chart, we've seen a consistent lower low, and lower high. So this is the continuation of a downward trend here at the moment. It still has failed to break back above the 20-day moving average here. So as it gets into that 150, 152 range, that becomes potentially an opportunity for small caps to continue its decline. It needs to get back above this 156 level here for it to resume more of a neutral state. And it would have to get back above 160 for it to resume more of a bullish state here for small caps. So small caps starting to roll over, and the decline that we've seen over the past few weeks has continued. Same thing here for equal weight S&P 500 in a very similar price pattern here. We have lower lows, lower highs. The RSP a little stronger from the perspective of the weekly chart, still above the 20-week moving average, still above the 200-day moving average here on the daily chart, but a break below that certainly puts us into significantly weaker territory. So as you can see, equity markets, domestic equity markets, still actually the strongest out of the global market. That's one thing to remember. When we look at globally, the picture is very, very mixed. The US markets, while we see these topping formations, both on a short-term and long-term trend, they do not at the moment signify more downside just yet. However, if we start to see those levels, those resistance levels I was talking about, if those hold, then we can start to see some downside. When we look at volatility continues to retreat from that 40% level on the VXN, which is the NASDAQ 100 volatility indices. The next test to the downside is the 200-day moving average, which, as you can see, has been rising for months and continues to provide support here, especially going into the election. We're continuing to see these elevated implied volatilities, but especially in the current moment when things are relatively stable from a directional perspective, this gives a unique opportunity to be selling volatility, selling covered calls, selling credit spreads, even iron condors and butterflies for those of you who like to trade those types of strategies. But this elevated implied volatility is a unique environment that allows you to generate a fair amount of yield compared to even a couple of months ago. When we look at the put-call ratio, we've seen a continuation of the put-call ratio improving over the past 3 weeks. But over the past couple of days, we start to see this 20-day put-call ratio moderate a bit. So puts are we're starting to see some call buying accelerate. Hasn't reached a peak yet, certainly hasn't reached the extremes that we saw right before the September sell-off, but we're starting to see this the call buying start to increase a little. So this is one that we're going to pay attention to, because if call buying continues to increase, that could be the catalyst the market needs to break out higher above some of those key resistance levels that I was referring to. When we look at Europe, this is the Stoxx 50. This is predominantly Germany and France in terms of an index perspective. As you can see on the weekly chart, has really been sideways for the past roughly three months or so. If you look at the daily chart, notice how it's just been trading in a very tight range-bound market. So what we have here is a breakdown of this range here over the past few trading sessions. It's coming back to retest that as resistance, and I think you could potentially see some further downside here. So Europe looking fairly weak, especially some of the developed markets. If you look at money flow, remaining fairly weak on both the daily and weekly chart. If we look at Hang Seng, the Hong Kong index, same thing, recently broke below some major support levels on the weekly chart and on the daily chart. On the weekly chart, sitting above some major support here, a breakdown below that level would certainly be fairly weak. This is one that we're paying attention to because this could be a potential turnaround candidate. Not 100% clear yet, but the fact that we recently broke below this trend line certainly is not particularly strong. You're more likely to see a continuation lower here on subsequent rallies. So Hang Seng breaking below some supports. Brazil also yesterday on some news about potentially some social programs to offset the income declines, seeing some breakdowns here below this $28 level here on EWZ, which is the MSCI Brazil ETF. Notice how it recently couldn't manage to make a higher high, actually made a lower high. And once you couple that with a breakdown of support level, this really puts Brazil into a much more bearish state here for EWZ. So when we look across the global equity markets, we're starting to see more and more weakness here. Does that point to US weakness? Not necessarily, but it does point to the fact that the US equity markets is the strongest out of pretty much everywhere we look around the world. Europe, Asia, South America, we're basically seeing US equity markets being the strongest. Is this a turnaround here for the US equity markets? Certainly we are, I think, at a very pivotal moment here. Keep an eye out on some of those resistance levels because those could tell us a lot about where we are headed next. When we look at treasuries, we continue to see a fairly strong bid here for US treasuries, but it hasn't moved much over the past few months. And we're starting to see a little bit of outflow out of some of the higher yield fixed income categories. High yield, investment grade have both seen outflows here over the past couple of weeks, and treasuries have seen some inflows. This also speaks a little bit to the risk off environment that we have started to see here since the beginning of September. So treasuries continuing to move higher here, which has caused dollar to move a little bit higher. So we've seen gold take that decline here. So gold recently broke below that 180 level. Now, the one thing that I do want to point out here, if you look on the weekly chart, we've seen the weekly approach the 20-week moving average on multiple occasions and use that as a potential buying opportunity. We've now checked back to the 20-week moving average, and the question is whether this chart will continue here to the upside. So if we look at the longer-term chart on the daily chart, the weekly chart certainly looks like it's approaching some support levels. Is this a potential opportunity to go long? I certainly think that from a technical perspective, you're starting to reach some of the levels. Perhaps it makes another move here to the downside before it starts to move higher here. But rates, there doesn't seem to be any time on the horizon where we would see rates lift off, which is generally speaking bullish here for gold. So as we see some declines here in gold, we may consider them as opportunities to look for a long position or start building a long position. If you're out of gold, if you still have a gold position, this might be an opportunity to look for some additional purchasing. When we look at the economic numbers perspective, this is really a fairly mixed picture. Manufacturing indices continue to surprise here to the upside and still look particularly strong. Durable goods came in fairly weak here. We were expecting about a 1% increase in durable goods. The actual number was only 0.4, so a fairly significant disappointment here to the downside, especially since we've seen consumer spending away from services, movie theaters, things like that, into durable goods like physical goods, cars, washing machines, things like that. Durable goods has really been driving some of the economic recovery and some of the spending that consumers have been doing. So durable good orders coming down, certainly one of the economic indicators pointing to some potential weakness coming up from consumer spending numbers. Another one that really has contributed to a lot of the weakness that we've seen here in September is really the probability that investors feel that we are going to pass a new stimulus before or after the election. And pretty much until the beginning of September, the markets put about almost a 90% probability of passing this between August and October, so before the election. That number has now plummeted to just 18% about 3.5 weeks later, almost 4 weeks later rather. So this has been a significant change in investor sentiment, and the number of investors that now believe that this stimulus won't go through until after January is now at 77%. This has put a damper here on consumer spending expectations. And if we look at consumer spending expectations across the board of the reopening trends, we certainly continue to see dining improve week after week, predominantly fairly consistently. But if you look at airline passengers, that's predominantly a very slow increase here over the past 3 months or so. And hotels also flat, but actually recently starting to see some declines, both in terms of occupancy, in terms of the average daily rate, and the revenue per daily rate have started to see the decline here over the past few weeks here. So very mixed picture in terms of the recovery and the economic data that we're currently looking at. And I think that's partially what's driving some of the weakness that we're seeing from equity markets. So I wanted to take a look at some of the ideas that we're taking a look at. Specifically, I wanted to show you how I'm looking at these charts to gauge a directional view, because everyone's asking us that same thing. You know, everyone has questions on specific stocks. I want to give you a bit of a template as far as how I'm viewing these stocks. So if we look at a big cap name like Microsoft, which we've been getting a lot of questions on the weekly chart, clearly still a very strong stock. So relative strength perspective, extremely strong. But what we're starting to see on a lot of these big tech names, are formations that start to look like what looks like the beginning of a head and shoulders formation here. So we have a left shoulder here in the 215 area, a head in the 230 area, and now we're approaching that 215 area again. So is this the start of that right shoulder before it starts to roll over, or can we start to break out above this right shoulder and then validate this topping formation and start to continue moving higher? So we are really approaching some of these levels, 215, 218 here for Microsoft. You can pull up any mega cap stock name, a mega cap tech name, and you can see a very similar setup here. The concerning thing here for me is that Microsoft a few weeks ago, or a couple of weeks ago, started to push below 200, which is a major line in the sand here. So this is really kind of the range bound that we start to see to play out here. And the question is whether Microsoft stays within this range and starts to break lower, or does it potentially invalidate this range and continue moving higher? So we are at the cusp of a major reversal point here, potentially. So keep an eye out for some of these names. You can draw a very similar type chart for most of the tech names, but we're starting to see this head and shoulders formation potentially on equity markets, on tech names. So keep an eye out for that. On the flip side, you have some names that have invalidated that topping formation, such as some of the semiconductor stocks. So Marvell's starting to break out actually to the upside. So as you can see over the past few weeks, consolidating a little bit, but yesterday starting to break out and potentially breaking out above that all-time high and continuing higher here. So we do still see quite a few sectors, industries that do fall into this camp where they are starting to break out higher. They've validated that kind of topping formation. We're seeing in some of the semiconductor stocks. We're seeing in some of the housing stocks, if you look at DH Horton. So there's certainly still some stocks in the markets that exhibit this ability to break out above or invalidate those topping formations after the correction that we've had over here for the past couple of weeks and starting to move higher here. You also see it in some of the staple names like Costco. Costco potentially a breakout candidate. Initially, a fairly, I would say, negative reaction to earnings, but over the past couple of trading days has started to resume and break out above that 350 level. If we can get a true breakout here above that 350 level, that could resume bullish trends here for Costco and retest that all-time high here around that 363, 364 level. So we are starting to see some of these more defensive stocks take some of these types of invalidate some of these bottoming formations and starting to turn the momentum back around. As you can see on both the daily and weekly chart, remaining fairly strong here for names like Costco. But on the flip side, we also see, as we showed you before, in some of the hotel names, hotels is one of the reopening categories that actually has seen a decline here over the past couple of weeks, especially when you look at Las Vegas and the exposure that they have here too in terms of tourists versus conventions. And when we look at some of the numbers for Vegas, convention numbers are still flat out zero across the board. There's no conventions being, meaning no corporate travel being done. So if we look at that, and if we look at LVS, which is on the long-term trend chart, still fairly bearish, still below the December 2018 lows here at the moment, actually retesting those levels here around that $48 level. So on the daily chart, what you have is a stock that has basically moved sideways between this 44 and let's just call it 52, 53 top here. Now, when you consider that, what you have here is a market that's moving nowhere on an absolute basis, but if you compare it to relative to the market, it's actually continuing to underperform. So when you see strong rallies like we've seen over the past few trading days, that is a potential opportunity to look for a fade or look for the markets move sideways and then start to move lower. So selling calls credit spreads are potentially a strategy that you could utilize for a type of weakness or stocks that are weak like Las Vegas Sands. And then if you look at names like American Express, huge companies that is continuing to underperform. So American Express has a fairly outsized exposure to corporate spending as well as a higher income bracket. And those are both spending brackets or categories, if you will, that we continue to see declines. When we see consumer spending continue to be fairly strong, most of that is actually coming from lower income households. Higher income households have actually significantly decreased their spend. So when we combine the two, when you have corporate spend at almost a standstill and you have higher income spend coming down compared to the same time last year, you look at stocks like American Express that predominantly have outsized exposure to these two groups. This is another one that I think is going to continue to underperform. And from a chart perspective, from an absolute basis, it's been moving sideways, which means relative, it's been moving lower. When you have strong rallies like we've seen here over the past couple of days, that can potentially provide an opportunity, especially when you put it into the context of the fact that American Express on a daily chart, as you can see, continuing to lower the 200-day moving average, providing a fair amount of resistance every time it gets up there. We're close to that 200-day moving average again. This is a potential opportunity to look for fading that strength here using call credit spreads. So that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to where we currently sit within the equity markets. Like I said, U.S. equity markets at the moment still extremely strong, but if you look at the global markets, starting to see a fair amount of weakness from other global markets. And what we're starting to see is these kind of topping formations start to form on big cap indices, small cap indices starting to look a little bit weaker. And then if we look at some of the constituents, the big names that drive the U.S. economy, we're also seeing some of that topping formation. Markets can invalidate those and continue moving higher. That's where we are at. We're at that pivotal moment to decide whether we can break out higher and can resume this longer term structural bullish trend, or is this where markets are going to fail and potentially start to turn lower. So in the next few trading weeks, next few trading days, I think we're going to get some clarity to those answers. So with that, it looks like I have a couple of minutes to answer some questions here. What's your opinion on the Indian markets? I currently am not following the Indian markets, so it's really hard for me to say. I can take a look at that next week and include that in my analysis. Christian, what do you see in WFC? So Wells Fargo, definitely the weakest out of all of the banks. So at the moment, XLF doesn't look particularly strong, but we continue to see this very slow rotation into XLF. So my only concern from a financials perspective is the fact that financials are slowly seeing this rotation into financials, but it's more of a rotation from the perspective that equity markets are looking weak and financials are looking less weak, in my opinion. So I don't quite see a breakout here in XLF. We do have earnings coming up in just a few weeks here on some of the major banks. That could be the catalyst that turns things around. But my thoughts are that, as you start to approach these 200-day moving averages, that's going to provide some upside, some limit to the upside here for some of the financial names. So Prudential, the insurance company is actually looking, I would say, a little stronger than some of the banks here. But Prudential, long-term underperformer here. If you look at the weekly chart here, I don't see a strong breakout here on Prudential, certainly below the 200-day moving average, as you can see, continue to provide long-term resistance here. So that is the level that I would pay attention to and potentially failure there. If we break out above the 200-day moving average, then you could potentially look at some resumption of bullish trends here for financials. OXY. So energy continues to be weak. I think energy will likely to continue to be weak. I don't see a strong case for a reversal here for energy, especially as climate change continues to become a bigger and bigger dominant, I would say, theme for investors, that energy stocks will continue to underperform, in my opinion. Thanks, always appreciate your thoughts on TWOU. to you. So, I mean, if you look at this chart here, I mean, this is a pretty clear downtrend here, and you're starting to approach the top of that channel. So as you approach the top of that channel, potential opportunity to look for further declines here, in my opinion. I think I've talked about the financials, so Citibank falls into that same group. Tesla has, continued this topping formation and hasn't broken quite out from that topping formation. Where do I think it's going to go? Hard to say, but my hunch is that it's more likely to break to the downside than to break to the upside. I think Tesla stock is a little exhausted here and fully valued here from my perspective. So that's my thought. If gold and silver fall into the same camp, you've got the revisit back to the 20-week moving average. Is this an opportunity to start to look for a long position? I think this certainly could be one potential reversal point here for gold and silver to potentially start moving back higher. Looks like I have a couple of more minutes here. McDonald's continuing, on this fairly strong track. It got back above that 218 relative high from back in February. It's just barely hanging on to that. Momentum indicators starting to show a little bit of weakness here. As you can see, the money flow starting to weaken here. So McDonald's is also on the cusp here of resuming its bullish trend and kind of bucking this topping formation trend. It's managed to break back above its highs from last week, which is certainly strong. Yesterday's price action wasn't particularly convincing, where it made it all the way up to 221, reverse lower here. We're about to open up flat here. I would watch this. If we can get back above 220, I certainly would put McDonald's back into a bullish camp here. Apple, same thing. Apple managed to clear back above a major support level here around 110 or so, but it's still trading just, shy of that 20-day moving average. I would really want to see a breakout above 118 and 120 here for Apple in order for us to resume our bullish trend. I think Apple's one of the companies that has a higher probability of that happening. Apple, Microsoft certainly has that probability, but until we get back above 118 and 120, I would put Apple in a much more neutral state here. Amazon, same thing, starting to form that head and shoulders formation here. So watch out for this 3,200, 3,300 level. If we can break back above it, resume bullish trend. But if we fail at those levels, that puts this larger head and shoulders formation into play, which would bring us all the way back into the 2,600 range. So with that covers what I wanted to share with you here this morning. I hope that you guys find this useful in starting your trading day and trading week. And I will see you guys here later this week on our next options education session. Thank you so much. Have a great trading day.